Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, before we talk about some potential trades that you've been eyeing, as well as a recent trade in Kumba, I know you want to start off, as you normally do, with a bigger picture, and that is a look at the S&P 500.
Yes, that's right. So the S&P 500 graph is up on the screen at the moment, and we've had this very powerful Trump rally over the last 2 to 3 weeks. Since it was basically 3 weeks since he won the presidential election in the US. And you can see the market's been moving up and up and up. It's hardly had any pullbacks at all since then. Yesterday, for the first time, we started to get a little bit of a whiff that maybe this Trump rally has begun to exhaust itself, and maybe we're due to see a little bit of consolidation now. And you can see that circled by yesterday's candlestick pattern, which did show a reversal of yesterday's trading action. And also notice how your stochastic oscillator is very, very overbought at the bottom there, and then the relative strength index, the RSI, is also turning down off extremely overbought levels. So I think it's probably not unreasonable to expect a little bit of consolidation from here, and maybe a pullback to retrace some of these gains that we've seen over the last 3 weeks or so.
Yeah, and on our own market, because we've been quite shaky. We were shaky yesterday. I'm not quite sure what impact the NEC's decision is going to have on the market today, because, of course, it does influence the rand, which is now weaker. Yeah. Where you see the market headed, or do you think it's maybe just slowly trickling south?
Look, at this stage, the technical structure for our top 40 still looks quite vulnerable to me. And if we have a look at that, you can see that very clearly there still is this pattern of falling highs that we've seen since August. In fact, it goes back even before that, but most clearly since August. Last week on the show, we said that the market seemed to be bouncing off that 43,000 area, but it would probably run into resistance at the underside of the 50-day moving average, and also potentially at this downtrend. And that's exactly what happened. You can see we actually had a bearish engulfing candle last week. I think that was last week Wednesday, if I'm not wrong, where the market reversed down off that resistance level, and it failed at the underside of the 50-day moving average, and it's begun to pull back a little bit since then. So, you know, for now, I still think that the technical setup here is looking weak. But having said that, yes, we've just had the news out of the ANC's NEC today, which said that Jacob Zuma lives to fight another day, and that's kind of been mooted all morning anyway. So we've seen the rand weakening quite significantly throughout the morning, and as a consequence, the top 40 is up today. It's well up off its lows of earlier this morning. But when I step back and ignore that and look at the technical setup here on the top 40 as I see it, I still do think that that is not a particularly healthy technical setup. And I would still be a little bit concerned that there may be a downside bias here.
Which is all quite interesting as we head into futures closeout. And I know you've got the slide, and you'll have to explain it, because there seems to be quite a lot of options of a weaker market by the time futures closeout rolls around on the 15th of December.
Yes, that's right. So what I've put here is just some of the most significant option strikes that are evident at the different levels on our top 40 as we approach the December futures closeout. The futures closeout is on the 15th of December, so it means that it's less than 3 weeks away now. And what you typically find is that as you approach that futures closeout, so the option strike levels become more significant, and the more potential there is for derivatives-related activity to drive the market. So what we've got here is a situation where there's quite a lot of put option interest in our market from 45,500 and downwards. You can see all the different strike levels indicated there with the quantity of put options that are written there. And I focused on the puts mainly because there are pretty much largely only put option interest at those lower strike levels. There's call options that are evident up at the higher levels, but that's far away from where we're trading at the moment. So I don't think those call options are likely to come into play on our market come the December futures closeout. As we sit right now, though, you can see there's quite a bit of put option interest at all of the different strike levels where we are now and moving lower. And the reason this is significant is because very often what you would have found is that the banks might have written those put options. And if anyone that's written a put option, if the market begins to fall, then what you typically need to do is sell into a falling market in order to hedge your put option exposure. We call that delta hedging. And it gets quite complex. But suffice to say, and just to keep it in its most simple terms, if we do see the market heading weaker, there's potential that some of that selling could be exacerbated by the fact that we've got all of this option interest. I mean, if you look there, 43,000 strike, there are almost 12,000 put options open at that level, which is a big, big open interest. So what it means is that if the market does start to drift lower, the potential for additional selling becomes greater. So it's going to be interesting. And the other thing to keep in mind is that, as we often do with the futures closeout, we have the Fed meeting, the meeting where the US Fed will announce its interest rate decision is the day before our futures closeout. The 14th of December is when the Fed makes its decision. The 15th of December is our futures closeout. So there often is potential for a big shock or a big movement on the day of that futures closeout when you've got such a lot of open interest in the options and you've had an overnight Fed decision which may or may not surprise the market. I'll never forget last year's December futures closeout where we saw the market rally 1,800 points into the closeout following a Fed decision.
Okay, but if it were to do that, though, how would you stand to either lose or benefit?
Well, we're quite nicely positioned for market weakness as things stand. So here's a top 40 chart. Now, this is a weekly graph of the top 40. So just bear in mind, every candlestick pattern here represents 1 week worth of trading action. And you can see that this chart goes back to the middle of 2014. You can see very much a sideways trading market for the last 2 years, 2.5 years. But this green diagram on the right-hand side really illustrates how we are positioned with our option structure. It's a put spread option structure, but against that we've got a long position on some December all-me futures. So it gives us this V-shaped payoff from around about 45,700 or thereabouts. As things stand at the moment with the market where it was when I did these slides at 43,800, you can see we are not far away from being at the sweet spot for this options position. So any further weakness as we approach the futures closeout, I think would be good for us. But obviously, it's 3 weeks in the market can be a long time.
And is it all going to be determined on the day itself?
Well,
how much you actually end up making?
Yeah, that's right. Because we typically run these structures out to expiry. So yeah, it will ultimately be dependent on the day as to how much we make on this thing.
Yeah. Okay. So a lot still can happen.
Yeah, a lot can happen in 3 weeks. But as it stands right now, from a technical perspective, it still looks as if we're quite well positioned. We are positioned for any market weakness, and if we get that, we're going to do nicely out of it.
Okay, Garth. Now, a share that you haven't gone short of, which you went long of, was it last week?
Yeah.
Was Kumba, and it's doing really nicely, and presumably you're still holding onto this position.
Yes, I am. So it's looking quite good. The chart of Kumba is up on the screen here, and what I identified last week was that this is a strong stock in a strong sector. We looked at all the relative strength of the sectors last week, and we said that the resources area of the market is by far and away the strongest area of the market. And if you're wanting to be doing any buying, that's probably the area where you're most likely to have the best chance of success. So we looked at Kumba. This stock is outperforming the resources sector as well as the rest of the market at the moment. And what I identified was this triangle structure which was forming. And typically these are bullish, well, they're continuation patterns. They can be bullish or bearish. It depends on what type of trend it forms. In this case, because this triangle is forming in an upward trend, we deem that to be a bullish triangle pattern, and we expect that it would break out to the upside and it'll continue in the direction of the trend that it was going in prior to the consolidation that formed the triangle. So you can see quite clearly there's 4 waves evident, 1, 2, 3, 4, and now the 5th wave in a triangle is usually the one that breaks out. And then approximately 2/3 of the time, a triangle structure that breaks out in the direction of the trend will then go on to meet its target.
Having said that, though, it's been sort of ticking up slightly, so it hasn't been a huge surge higher. And does that give you confidence, or would you cut out of it before your target, which is 180 Rand?
For now, I'm happy to stick with this trade. It's still making higher highs on a daily basis. So I think while that is the case, it still indicates to me that the buyers are in control here. So our target is 180 Rand, as you said. We went long of 400 CFDs at a price of 162.50. The stop loss we were using is 155 Rand. So all in all, I think this trade is working. It's going according to plan, and I'm happy to stick with it for the time being.
Okay. Garth, now there's 2 shares that you want to discuss this week. You haven't actually entered any positions on either of them. And I suppose it gets a little bit tricky now because we're heading to the end of the year. We want to make sure we have a pot of money to give to our charity of choice, and we'll be discussing that in the next couple of weeks. But what is catching your eye? Yeah,
so I've got 2 charts that I'm going to just highlight today and say these are things that are catching my eye. We're not going to trade them because we are right at the end of the year, and we're not likely to do too much more in terms of our portfolio, I don't think. But the one chart that's caught my eye is this chart of clicks over here. And what's evident to me is a big rounding top pattern that we're seeing over here. You can see that quite clearly illustrated. Notice since June, the share price seems to have been forming this big rounding top. And there's a pattern of lower highs and lower lows evident now since August of this year. And what we've got at the moment is the chart pushing up against the underside of the 50-day moving average, which you can see has been resistance on previous attempts at a rally. But the fact that the stock is making lower lows and lower highs, and it is now showing quite clear reversals off the underside of this 50-day moving average, makes me concerned that it's probably due for another leg to the downside. And if you think about the retail sector, it has been hammered this last couple of months. Clicks has held up better than the rest of the sector, but I think overall this chart structure still to me does look a little bit concerning. And if I was going to put a trade on, I think I would probably look to short Clicks at current levels with a stop loss at about 127 or thereabouts. And I think there's a good chance we're going to go down and retest these lows at 110 again, and quite possibly even go lower than that. Also remember that Dis-Chem is listed now, so there's an alternative stock to choose in the pharmacy place.
Yeah. Although having said that, Dis-Chem didn't really endear itself to investors. So
it didn't, but I think from a purely diversification point of view, it's not unreasonable to expect that there might be a little bit of switching away from Clicks into Dis-Chem, just because there's now more choice in the sector.
Yeah. Okay, so Clicks is something that you might consider shorting, and the other one is Naspers. I'm sorry, not Naspers, Sasol.
Sasol.
I don't know why I've got Naspers on the brain, but I do. It's not Naspers.
It's not Naspers, it's Sasol. So this chart I've shown on the show before, and it's still very interesting to me. What's really notable, I mean, this is a weekly graph of Sasol, and it goes back all the way to 2011. It just shows that since middle of 2014, this has been a very disappointing stock. And it's been bumbling along at these lower levels, testing this lateral support at 360 Rand over and over and over and over. I mean, it's tested it dozens of times over the last 2 years. And my suspicion here is that when you get a flat support level like this that gets tested and tested and tested and then doesn't result in a meaningful rally to the upside, which is the case here, it's making lower lows and lower highs. I think that support level is very vulnerable, and I think it won't surprise me in the least if we see this share price breaking below 360 at some point. And I think if that does happen, that'll be quite a violent break, and you could very well find this share trading down into another 10% lower quite quickly. It's not a share I'd be wanting to buy at this stage. If I'm brave, I would possibly even look for a shorting opportunity, because I really do think that setup looks very, very vulnerable to a downside break.
And I suppose what is going to be key for Sasol is what happens to the OPEC meeting, or at the OPEC meeting tomorrow, I think.
Yes, this week we've got an OPEC meeting where it'll be discussed whether to reduce production or not. But so far, early indications are that it's not going to come away with a cut in production. The Russians have already pulled out of that meeting. So it doesn't look as if there's a high probability that oil production will be cut at that meeting. Yeah. And you've started to see the oil price drifting off a little bit already. And then, of course, the other thing to keep in mind with Sasol always is the Rand, because it's very sensitive to the Rand-dollar exchange rate.
Or maybe Sasol will be saved by Jacob Zuma. You never know. Garth, what does the portfolio look like at the moment?
So we've had a good week. We're up almost 25% now for the year to date. So we've had a very good week because our option structure is working for us with the recent drop-off in the market. We've made money out of that. And then this Kumba trade is also working. We're up 3,184 Rand on Kumba as things stand. So we've got 312,000 Rand in the bank. As we approach at the end of the year, we're on a new high for the year, which is awesome. And I hope that we can go out of the end of the year with on our highs. It would be wonderful.
Yeah, a bang in a good sense.
Yeah.
Garth just turned off with a reminder that you can always get a weekly reminder from Traders Corner as to what's coming up in the show.
That's right. We've got a free email list that viewers can subscribe to. If you go to traderscorner.co.za, you'll see that there's a link in the middle of the page for a free weekly email. And on that email, we'll simply send you a quick update on what we're going to be discussing on this show every week. It'll come out at midday on a Tuesday. A nice, short, concise little email to tell you what's coming up for the week.
Okay, we'll leave it there. Garth, thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.